Imagine if you could look at a single number on your screen and know exactly when the stock market was about to hit rock bottom and bounce back. For decades, investors have searched for a crystal ball, some secret indicator that screams, buy, right when everyone else is panicking and selling their life savings. Most of these indicators turn out to be nothing more than financial astrology, leaving hopeful traders with empty bank accounts. But what if there was an indicator born not from complex math or corporate earnings, but from the rawest human emotion of all, sheer, unadulterated fear? In this video, we're going to look at a famous method that tries to do exactly that. We will strip away the hype, ignore the marketing promises, and put this approach to the ultimate test using 10 years of real, cold historical data. No opinions, no cherry-picked examples, just the raw numbers. To understand this approach, we have to talk about how the market behaves when things go south. When stock prices drop, they don't just drift down quietly, they plummet in a wave of anxiety. This is where the concept of a fear gauge comes in. Officially known as the Volatility Index, or VIX, it measures how expensive options insurance is on the S&P 500. When investors are calm, the VIX is low. When they are terrified, the VIX spikes. The strategy we are testing today is the VIX-based market timing strategy, popularized by trading experts like classical technical analysis. The core philosophy is simple. When fear reaches an extreme, unsustainable peak, it often marks the absolute bottom of a stock market correction. By measuring how far the VIX has stretched above its own average, we attempt to time the exact moment of maximum panic, step in when others are fleeing, and ride the subsequent recovery. So how does this strategy actually define maximum panic? It doesn't just look at the absolute level of the VIX, because what is considered a high VIX today might be normal tomorrow. Instead, it uses a concept called the stretch indicator. First, we calculate a 10-day simple moving average of the VIX. Then, we look at the ratio of the current daily VIX price relative to that 10-day average. When the VIX stretches significantly above its moving average, say by 10% or 15%, it tells us that fear is accelerating at an abnormal pace. This is our signal that the market is in an oversold, highly emotional state, and a snapback rally might be just around the corner. We are specifically looking for moments where the VIX stretches past these critical thresholds, signaling that the panic has become overextended and unsustainable. Let's look at exactly how a buy signal is generated under this system. When the VIX stretch ratio crosses our predefined threshold, it triggers an entry signal. We immediately buy the S&P 500 ETF, which goes by the ticker SPY. The theory is that we are buying at the point of maximum capitulation. But we can't just buy and hope for the best. We need a strict exit plan. In this implementation of the VIX-based market timing strategy, we hold our position until the VIX drops back down and crosses below its 10-day moving average, signaling that the panic has subsided and the market has stabilized. Alternatively, some variations use a fixed time exit or a trailing stop loss based on average true range to protect capital in case the panic continues to deepen. This combination of an explosive, fear-driven entry and a structured exit is what makes this strategy highly regarded in classical technical analysis. Historically, trading against extreme fear has been one of the most profitable, yet terrifying, ways to make money in the financial markets. Think back to the major market corrections of the past. During the global financial crisis of 2008, or the sudden, violent pandemic crash of early 2020, the markets fell with unprecedented speed. Most retail investors froze or sold at the very bottom, locked in their losses, and missed the massive recoveries that followed. The VIX reached historic highs during these periods. A strategy like this is designed specifically to take the emotion out of these chaotic moments. It forces you to buy when your gut is telling you to run away. But does this aggressive contrarian behavior actually work over the long run? Or does it just expose you to catastrophic losses when a true, multi-year bear market takes hold? Let's find out. To find the truth, we ran a rigorous backtest on SPY spanning a full decade from August 6, 2016, all the way to August 6, 2026, representing 10 years of market history. This period is a perfect testing ground because it contains almost every market condition imaginable. The steady bull market of the late 2010s, the extreme volatility of the 2020 pandemic, the painful inflation-driven bear market of 2022, and the subsequent recovery. For our specific setup, we buy SPY when the VIX stretch ratio exceeds 1.10, meaning the VIX is 10% higher than its 10-day moving average, and we exit the position when the VIX falls back below its 10-day moving average. We also implemented a standard trailing stop loss to prevent a single bad trade from wiping out our entire account. Let's look at the raw performance metrics. The backtest is complete, and the numbers are in. Over this 10-year period, the VIX-based market timing strategy executed a total of 45 trades. This relatively low number of trades shows that the strategy is highly selective, staying in cash during quiet market phases and only deploying capital when genuine panic strikes. Out of these trades, the strategy achieved a win rate of 42.2%. A win rate like this is critical for a contrarian strategy, because buying during a falling market can lead to a lot of small losses before you catch the big turning point. Let's look at how these individual trades added up over time to affect our overall portfolio value, and see if the strategy managed to outperform a simple buy-and-hold approach. Now, let's look at the bottom line performance. If you had simply bought and held the S&P 500 ETF, SPY, at the start of our backtest in 2016 and kept it until 2026, your buy-and-hold return would have been plus 314.4%, which translates to an annual growth rate, or CAGR, of plus 15.3%. In comparison, the VIX-based market timing strategy delivered a total return of plus 36.3%, representing a compound annual growth rate of plus 3.1%. When you compare these two equity curves side by side, you can see how the strategy behaves. Because it is a market timing strategy, it spends a significant amount of time in cash, meaning its equity curve is flat during long periods of steady growth, but it seeks to jump ahead by capturing rapid gains right after steep market sell-offs. But raw returns only tell half the story. As any experienced trader knows, you have to look at the risk you took to get those returns. This is where we look at the maximum drawdown, which represents the largest peak-to-trough drop in account value. During our 10-year backtest, the S&P 500 experienced some brutal drawdowns, especially during 2020 and 2022. The maximum drawdown for the VIX-based market timing strategy was minus 7.6%. Comparing this drawdown to the standard buy-and-hold drawdown is eye-opening. By sitting in cash during prolonged bull markets and only entering during high-velocity panics, did the strategy succeed in smoothing out the ride, or did the high volatility of the VIX signals lead to sharp, painful whipsaws that tested our emotional resolve? To get an even deeper understanding, let's break down the performance year by year. Market timing strategies often have a very lumpy distribution of returns. In quiet, steadily rising years, a strategy like this will almost always underperform buy and hold because it sits on the sidelines in cash, earning nothing, while the market slowly climbs. However, in highly volatile years, like 2018, 2020, or 2022, this strategy has the potential to shine. By dodging the initial phases of a market crash and buying near the absolute lows, it can generate massive positive returns in years when buy-and-hold investors are suffering heavy losses. Looking at the annual breakdown allows us to see if the outperformance was driven by consistent, year-over-year success, or if it relied entirely on one or two incredibly lucky trades during major crises. This brings us to the critical limitations of the VIX-based market timing strategy. While the theory of buying fear is incredibly compelling, executing it in the real world comes with serious challenges. First, there is the risk of falling knives. Just because the VIX is 10% above its moving average doesn't mean it can't go 50% or 100% higher. During a prolonged systemic crisis, like the 2008 recession, buying the initial panic would have led to severe losses as the market kept crashing week after week. Second, this strategy suffers in low volatility, grinding bull markets. If the VIX stays suppressed for years, you will generate very few signals, leading to massive underperformance due to the opportunity cost of holding cash. Finally, transaction costs and slippage can heavily erode profits, as you are executing trades precisely when market liquidity is lowest and bid-ask spreads are widest. In conclusion, the VIX-based market timing strategy is a powerful tool for traders looking to capitalize on market panic, but it is far from a magic bullet. It requires extreme discipline to execute, a tolerance for buying when the world feels like it's ending, and the patience to sit in cash for months at a time. It works best not as a standalone portfolio, but as a tactical overlay to boost returns during periods of high macro uncertainty. If you found this data-driven analysis valuable, make sure to hit the like button and subscribe to Backtested Hub. We don't sell courses, we don't make wild promises. We just run the code, analyze the history, and show you the truth. Let us know in the comments which classic strategy you want us to backtest next, and we will see you in the next video.